Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, May 16, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. Markets were up across the board today. So far, this market, the Spider, the S&P chart, is holding this downsloping trend line. That's very interesting information. We started talking about it yesterday. We closed, for the most part, on the trend line. And today, we have an up day. And we talked about this ahead of time. We talked about the fact that in getting above the trend line, peeking our head or spiking through the trend line on the upside, and that's where the market made at least a pseudo doji candle, a signal of a trend change. Now, so far, it was only a one-day trend change. Whether there's more downside coming imminent right now is really a question mark. We have some things to discuss. We have our favorite market leading indicators and what they did today and what the market is really telling me. So let's discuss for a second what the market is telling me. Forget about the downsloping trend line. Forget about the signal of a trend change from the other day. If we just look at price on the chart, and we say, are we in a bullish or a bearish from a short-term perspective? I mean the next several days, not necessarily weeks or even beyond that, but just the next several days. Are we in a bearish or a bullish position? And being above all the moving averages, the 200, the 20, 50, and 100 period moving averages, I'd have to say, at least from a short-term bias perspective, I would have to have a bullish bias. Now let's bring the trend line back into the equation. We're above the trend line, this downsloping trend line. That should have been, under normal conditions, resistance to the market. We did put in a signal of a trend change. We had one down day. It was a pretty decent down day at that in the S&P. Not every index was down, if you remember from yesterday, and we'll get back to that in a second. But we had one down day. We came in to test the bottom of this green candle, the 100 period moving average. We closed on the trend line, and today we're back above the trend line. A second reason that, at least while we're above the trend line, have a bullish tint to the market. We can't really be bearish until yet we're back below the trend line. And what would open up the door on the downside for more downside if that was going to be the case? That would be a close below yesterday's low. So we close below on the daily chart, below yesterday's low, or even begin closing hourly below yesterday's low, and we're likely to come back into at least these moving averages, maybe down to the 266.50 that we discussed last night. But that's not where the market is today. We have to address where the market is today, and the market's above the trend line, so it has to have at least a bullish bias for the short duration or short term. Now here's the thing on the upside. If in fact we do go higher, and we actually take out the high from Monday, that was the pseudo doji candle. Now if we close above that high, again, it's further evidence of more bullish behavior, but in my world, $275 is going to be another major area of overhead resistance. So even if we do push a little higher, we're likely to find resistance at 275, maybe slightly above 275. Maybe the market holds up there and closes up there, maybe it doesn't, but either way, at least from my work, I have 275 as overhead resistance for the market, which really isn't that far above where the high of Monday's close was. Remember, it's the market's job to trick, trap, and fool as many traders as possible, as many investors as possible, as many market participants as possible. Was yesterday the trick, or was today a trick? We'll find out soon enough, but I can't be bearish above this downsloping trend line right now. And by the way, the volume today across the Spider chart was 52 million shares, or almost 53 million shares. That's extremely light. The average daily volume is a little less than 95 million shares. So again, we have to take the volume into consideration. And when volume is very light, it's unlikely the market has a heavy sell attached to it. Light volume certainly has the path of least resistance to the upside. You've heard the saying, or maybe you haven't, but you should, which is never short a dull market. So when the down days do show up, we have a pickup in volume. But when the volume is very light, we're unlikely to get an intraday turnaround without some kind of a catalyst, of course. When we go down and look at the intraday chart, is there anything that we can see on the chart that we can A, learn from, and B, tell us something of what might be coming in the coming hours or days? Well, first, we're focused on this area right here. This is today's activity. So this is where the market had a slight gap higher. We pulled back, we went higher, and we basically treaded water for the majority of the afternoon, had a little bit of a sell-off and then a rebound in the last 10-minute candle of the day, almost reaching back to the 20-period moving average. But what's also interesting that we can learn something from is in the morning session, you see what happened? We had a slight gap higher, then we went sideways for the better part of a couple of hours. And in the process of going sideways, what did the market do? It came down to test, not quite to the exact low, but towards the lower portion of this green candle, which was the first candle of the day. As you can see, this is the 9:40 candle, which means that this is the opening candle closing at 9:40 a.m. So before this market took off again to the upside, we came back in to test very close to the low of this green candle, which also happened to be the first candle of the day, also known as the opening range low. So we went down to test that. The market liked it, found support, and we took off to the upside. There was a round and interesting timing mechanism that took place in the morning hours before we actually took off again to the upside. Again, that's something that's discussed in detail in the course at Lazy E-mini Trader on how to use time to our advantage, knowing when the market's going to turn, knowing when the likely point in time that the market is poised to make a turn is certainly helpful, and knowing how long a market may trend in a specific direction. When a market trends in a specific direction for a certain period of time and ends up testing an important price level, then you have price and time meeting or converging, and that's what positive trades are made of, and that's what's taught in my course at LazyEminiTrader.com, how to put price together with time. And by the way, I forgot earlier, but I do want to have a slight intermission and thank everybody for their continued participation, commenting on the videos, providing your thoughts about the market, the economy, about the content of the videos, questions. It's all good. It's all great. It helps everybody, so please continue to participate, and also please continue to like the videos, and please continue to share the videos with those you think that can benefit from this information. It's helpful to the entire community. I'm trying to pay it forward. If you pay it forward a little bit too, everybody benefits. We all can learn together. So thank you very much for your continued participation and interest in this content. Now we'll take a look at the hourly chart of the spider and see if we can determine where we're likely headed early hours in the morning on Thursday. And the first thing we see is we had an up move and we've been going sideways, right? So this is considered a flag pattern. It's considered bullish consolidation. It's considered a channel in the upper range, whatever you want to call it. Okay, the market is consolidating. Generally speaking, when the market does this, it's consolidating to build energy for another push higher. Let's see what else we have on the chart that's meaningful. We have a gap fill that needs, or a gap that needs to get filled right up here at 272.92, I believe the number is. And we have not filled that gap as of yet. They made an attempt at it earlier in the day, came up short. So we could potentially be building energy going sideways for another push higher to fill that gap. Could we go higher than that? We still can satisfy the $275 level on the spider. Whether we close up there or just hit it on an intraday basis, that remains a mystery, but it's still a possibility. $275 on the spider. Now we're going to take a look at the IWM. Go back to the daily chart, and we'll see here that we've broken out on the IWM. We've now closed at a new high. That's important for the IWM. Let's go back to something we talked about yesterday. So yesterday, I was very clear that I was not able to be bearish the IWM. The IWM has been holding up. The IWM has certainly been leading the market on the upside. There's been a couple of days where there's been a divergence between the spider and the IWM. We talked about them each and every day in this video here. But what happened yesterday was, and we talked about it yesterday, we were not able to close below the low from the prior day. Monday's low was important. The fact that they rallied the market yesterday to close inside of Monday's low was important to me. That told me, A, I could not be bearish the IWM, and it also had to lean me toward the bullish side. That was a bullish sign. Today, we've broken out to new highs. We closed above Monday's high. That's another important development. As you know, the IWM is my favorite market leading indicator on the upside and the downside. Right now, the IWM is leading the way. It was up over 1% today. The spider was up 0.4%. Everything we discussed about with the spiders and everything we're discussing here on the IWM points to higher prices. Is that a guarantee? No. But these are where the probabilities on the charts are pointing me today. Couple of things that are important with that. So as a trader, as an investor, as a market participant, you have to be willing to ride with the wind a little bit. You have to be willing to change direction sometime because the market changes direction sometimes. Right now, it could be looking like a certain thing is going to happen and things can change and certain patterns can reverse or fail and things can go in the other direction. You have to be willing to understand that that's happening. You have to be willing to make an adjustment. You have to be willing to be in the market, in the present, based on what the market or the chart or both are telling you right here, right now. Right now, there's more puzzle pieces on the table. There's more evidence. There are more clues that the market is going higher than there are clues that it's going lower. That's from my read based on today's charts. How much higher in the IWM? Possibly as high as 164, maybe even higher, but I can see us getting up about another 30 points in the Russell, which would equate to maybe about another $3 or so in the IWM. I think that would be consistent with the 275 on the SPY, which should coincide with roughly 2,750, give or take, in the ES, the S&P E-mini futures contract. The Dow Jones transports. So we remain trying to get through these highs, have not been able to close above these highs yet in this range, in this channel that we're trading in. So here's the channel. We point this out every night, and we've stayed in this channel. We have not broken out of this channel. We had a similar channel in gold. We broke out to the downside. Whether these channels break to the upside or the downside, we just want to make sure that we're aware that we're in a channel and that we can identify a break. If it breaks out to the upside like this, or it breaks out to the downside like this, we may be able to participate in some opportunity. But right now, on a short-term basis, you can see that we're above all the moving averages. The market is consolidating, potentially to build energy to bust through the high end of this channel. As long as we stay above the 100 period moving average, we tested it yesterday, we're above it again today. As long as we stay above that, there's nothing wrong with this chart. There's nothing wrong with the daily chart of the transports. We can certainly make an attempt at higher prices. If the market gets a lift, a rising tide will lift all boats, and the likely scenario is you're going to see the transports get a lift higher. You're going to see all the markets get a rise and achieve some higher prices if we get that lift in the S&P. Here's an hourly chart of the Dow Jones transports. Now, I want to point something out. It's very important. Yesterday, we were looking at this bearish pattern. Under normal conditions, a bearish pattern like that is going to complete to the downside. Okay, so first we fail a bullish pattern, so that's negative number one. And then negative number two is we have a bearish pattern that will likely play out to the downside like this. Okay, now interestingly enough, look where we are now. We're back where we started from a couple of days ago. Not that this pattern from the bullish pattern is still intact. it's already been taken off the table. Yes, we're back up here, but what I want to point out is, look what happened, because I talk about this a lot, and you can see it in living color right here. We had a bearish pattern, and this will normally release energy to the downside like this. But what happened is, the same energy was released, it just got released in the other direction, and we went up instead of down, but it was the same move we would have been expecting. We would have been expecting a move out of this pattern. If you believe in market symmetry, and you know I do, we would have been expecting a move under normal conditions to be equidistant to using this high and somewhere in here. It's not an exact science, it's an approximation. It's for visual purposes for the most part, but you can see where that would have led us into the moving averages, the convergence of the 100 period and the 200 period moving average for a nice symmetrical move. So you had a down move, consolidation, another down move, and you likely would have found support. You also had this consolidation area here. The likely story is you would have found support right down here around 10,475, right around these moving averages for the completion of that hourly chart bearish pattern. But that didn't happen, but the same energy was released to the upside. And I just want to point out that either way, the energy is going to be released. Keeping in mind where we are from the bigger picture perspective, here's a weekly chart. We're above the 20-week moving average. Now, this is still a long-standing channel. It's a bearish consolidation pattern that will likely have another down move inside of it, or as a result of it. However, right now, we have to be, or at least we can't be bearish while we're above the 20-week moving average. And if we close this week on Friday above that level, that's going to be the second week in a row back above that level. So it's very hard to be bearish under circumstances like that, but there's a long way to go before Friday's close. I just want to point it out. And it's not so much that it's the transports, it's how I read the charts, and you can apply that same philosophy, the same tactics to any chart under the sun. It doesn't really matter. All charts act and react the same way. I'm just using the transports in this case to point something out and use it as something we can learn together from. Real quick, we'll take a look at a chart of the Qs. So on Monday, we did put in a doji candle. We had the down day yesterday, and we had somewhat of a rebound today. Whether or not it's a garden variety retracement and we have another move down, that's possible. But on the other hand, we can say that this market could be just consolidating or eating time off the clock in this area, well above all the moving averages, well above the convergence of the 20, 50, and 100 period moving average. We may be just eating time off the clock, letting the 20 catch up to price, setting up for another move higher. That is possible. It's also possible, right, not to talk out of both sides of my mouth, but I have to tell you both sides of the equation. Looking at this chart, it's certainly possible we come down towards these moving averages, but still stay ultimately in a bullish scenario above the moving averages. So you get kind of both things going on. You get a down move, but the market's not really in a bearish stance. That's certainly possible. But right now, the volume is light. The market looks like, when we look at all the different puzzle pieces that we've already put on the table here tonight, it's very hard to see where there's downside activity imminent from the chart behavior, from price action. It's very hard to see that. Now, we're fully aware, we're all fully aware, I am and you should be fully aware that we could wake up any day and anything is possible. We could be down 50 handles in the S&P by the morning tomorrow. That's certainly possible. But what I'm doing and what I have to do is talk about what the charts are telling me each and every day. Something happens, some exogenous event, a black swan event. It is what it is, and we have to deal with it at the time. But that's also the market for you. Remember, trick, trap, and fool as many traders and investors and participants as possible. What are the financial indexes telling us tonight? Well, here's the XBD, or the broker-dealer index, and frankly, above all the moving averages, we are making a pretty nice and tight bullish flag pattern. So we have an up move, and we've just been consolidating in this flag pattern. This is generally the market's way of telling us what? It's telling us it wants another leg higher to attempt the old highs. That's the highs on the daily chart here. That's what this pattern is telling us. We're above the moving averages. Very hard to see a scenario where we have downside activity coming out of this pattern. As long as we're above the 20 and the 50 moving average, this is a bullish chart. This chart is telling us it's building energy for a move higher. Looking at the XLF, it's the same scenario. We're essentially doing the same consolidation right underneath the 100 period moving average. Is this market consolidating under the 100 to build some energy to go test this area and fill the gap right up here around 28.75 or so? Well, let's get that exact number. The actual number is 28.72. Is that what the XLF is building energy to do? Another day or so of sideways consolidation in a flag pattern and like this, and then the market's going to be ready for that next push higher. Can it fail? Sure. All patterns can fail, but what I'm saying is the probabilities, the majority of the time, these patterns don't fail. Yeah, they'll fail maybe 20, 25, maybe even 30% of the time, depending on the type of pattern, depending on a lot of different, items. There's no way to track exactly how much percentage of the time a certain pattern might fail across all charts. It's impossible to know that, but the reality is around 25% of the time, these patterns are going to play out, this one to the upside. So that's what I have to go with. I have to go with the highest probability that the chart is telling me. We've been looking at the SOX lately, and what is the SOX daily chart telling us? The SOX daily chart is telling us the technology sector has strength. It was up 1.4% today, 19 points in the SOX, and it looks very similar to the Qs chart. It looks almost identical to the Qs chart. The question is this a fake out and just a retracement from the high made on Monday and we go back down, or are we going to push to higher prices? We do have a lot of overhead resistance just above us right here. Okay, that's not going to go away, that overhead resistance. Then we have another gap right above that. So as we approach the 1400 area, there is a ton of overhead resistance on this chart. So even if we do push up slightly more, slightly higher, there's still overhead resistance just above. Gold, pretty flat today. We took a little bit of a dip lower today, but finished for the most part, or finishing where we opened today. So there's not a lot we can do with today's activity in the interest of finding additional information. Nothing really happened today. Likely lower prices coming in gold. I don't think we're going to change anything from what we said last night. We could come all the way down to $1,260, fill that gap. In gold, it's not going to go there in a straight line, but it's certainly possible. I've been getting a lot of comments about the correlation between the dollar and gold. And yes, certainly when the dollar is very strong, it's typically negative for commodities, generally speaking. It's typically negative for gold and it's negative for crude oil. But let me throw a little bit of cold water on that concept. So there are plenty of times where the dollar will be strong and gold is going higher, or at least not going lower, but nobody ever mentions the fact that they're correlated in a negative fashion when that happens. That's item number one. Item number two is we typically have correlated gold and oil against the dollar in an inverse correlation, but the dollar is screaming higher, as is crude oil, but gold is going lower. So I'm reluctant, and here's the answer for the folks asking about the correlation. It's correlated sometimes, and sometimes it's not. So therefore, I don't know what you can do with the fact that while sometimes it's correlated and other times it's not, what do you do with that information? There's not a lot you can do with that information. If you want to note it, if you want it to be a puzzle piece, that's fine. But there's nothing you can really take action on. Knowing that correlation, whether it exists or not, is debatable. If you want to believe it exists, great. It exists sometimes. Other times it doesn't. And it always has typically existed whenever the media was talking about it. It was gold and oil inversely correlated to the dollar. Well, obviously, oil is continuing higher, and that does not have an inverse correlation. Oil is priced in dollars, so why is it going up and gold going down while the dollar is going up? I don't believe there's a hardline correlation with anything. I think each chart trades and acts and reacts of its own volition. That's my position. I've always had that position. I certainly like to use other markets as indicators for one thing or another, but But to correlate markets, there's really no benefit in the long run. Whether it is or it's not is up to the individual trader, whatever they want to believe, and we'll just leave it at that. Speaking of crude oil, we'll go over to crude, and you can see here that, we creeped higher today, 71.54. We're getting close to our hot zone, right? We're just kind of butting up against the top end here. My guess is we're going to have, a day or over 2 days where crude oil is up $2 or $3. We get into the hot zone, and then we will begin looking for signals of a trend change. So all in all, nothing has changed in the outlook on crude. Crude continues higher. If you happen to be in some kind of long position correlated or related to crude oil, you want to begin taking profit, or at minimum of having a tight stop loss if and when we do get into that hot zone area. And with that, folks, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.